Most beginners think investing means finding the next stock that will explode. That is why their first portfolio often looks like a junk drawer. A little crypto, 3 famous companies, 1 random ETF, and no idea what any of it is supposed to do. But a strong portfolio is not a collection of exciting names. It is a team. Every investment needs a job. And for most beginners, there are only 5 jobs worth understanding. In the next few minutes, I will show you the 5 building blocks, what each one is for, where it can fail, and how they can fit together. By the end, you will be able to look at almost any portfolio and understand what is missing. This is educational information, not personal financial advice. Your timeline, taxes, income, and risk tolerance matter. Before choosing an investment, choose a deadline. Money you need next year should not be treated like money you will not touch for 30 years. The SEC calls this your time horizon. A short deadline usually demands stability. A long deadline gives you more time to survive market declines. Think of 3 buckets. The first is money you may need within 3 years. The second is money for goals roughly 3 to 10 years away. The third is long-term money, often for retirement or another goal more than 10 years away. Now we can give every investment a real job. Investment number 1 is cash and short-term Treasury bills. Their job is not to make you rich. Their job is to keep a near-term goal from being destroyed by bad timing. Cash may sit in an insured savings account. Treasury bills are short-term securities issued by the United States Treasury with maturities of 1 year or less. They are designed for money that needs a high degree of stability and liquidity. Imagine you are saving $20,000 for a home down payment next summer. If that money is in stocks and the market falls 25%, your home plan just became a market bet. The problem was not that stocks are bad. The problem was that the investment and the deadline had different jobs. The weakness of cash is inflation. Even when the balance does not fall, its purchasing power can. That is why cash is excellent for emergencies and short deadlines, but usually weak as the only long-term investment. Investment number 2 is bonds. A stock makes you an owner. A bond makes you a lender. Governments, cities, and companies issue bonds to borrow money. In exchange, they promise interest and repayment of principal according to the bond's terms. Bonds can bring income and reduce the volatility of a portfolio, which becomes more important as a goal gets closer. But bonds are not a magic safety button. Bond prices can fall when interest rates rise. Companies can default. Longer-term bonds can move more sharply than many beginners expect. Even bond funds can lose money. The useful question is not, are bonds safe? It is, what risk is this bond taking, and does that risk fit the job? Shorter-term, high-quality bonds may serve a medium-term goal very differently from a long-term, high-yield bond fund. Investment number 3 is the growth engine, a broad United States stock index fund. An index fund is a mutual fund, or ETF, designed to track a market index. A broad market fund can spread your money across hundreds or even thousands of companies. Instead of betting your future on one chief executive, one product, or one industry, you own small pieces of many businesses. This does not remove risk. A broad stock fund can fall hard during a recession or panic. The protection comes from diversification, not from avoiding declines. This is why timeline matters. Money needed soon should not depend on the next market recovery. But for a goal decades away, broad stock exposure can provide the long-term growth that cash is unlikely to deliver. Check what the fund actually tracks, its expense ratio, and its top holdings. 2 ETFs with different names can own almost the same companies. More funds do not always mean more diversification. Investment number 4 is an international stock index fund. The United States has many of the world's largest businesses, but it is not the entire global economy. International funds can add companies from Europe, Asia, Canada, emerging markets, and other regions. Why own them? Because leadership changes. One country or market can dominate for years and then lag. International diversification reduces the size of the bet that one nation will always outperform every other nation.
International investing adds its own risks: currency movement, political uncertainty, different regulations, and periods of weak performance. It is not automatically better than the U.S. market. Its job is to widen the opportunity set and reduce concentration. Investment number 5 is real estate exposure through publicly traded REITs, or real estate investment trusts. A REIT is a company that owns or operates income-producing real estate, such as apartments, warehouses, self-storage facilities, offices, or shopping centers. A REIT fund can let an investor own a small share of many properties without becoming a landlord. REITs can add a different source of income and economic exposure, but they are still investments, not guaranteed rent checks. They can fall with the stock market, struggle when borrowing costs rise, or suffer when a property sector weakens. And here is an important detail. Many broad stock index funds already include REITs. Adding a separate REIT fund is optional. It increases real estate exposure. It does not create a brand new universe that your portfolio necessarily lacked. Now put the jobs on one page. Cash and Treasury bills protect short deadlines. Bonds can add income and reduce portfolio swings. A broad U.S. stock index fund provides diversified business ownership. An international index fund reduces the bet on one country. REITs offer optional extra exposure to income-producing real estate. A very simple long-term portfolio might use one broad U.S. stock fund, one international stock fund, and one bond fund. Cash remains outside the portfolio for emergencies and near-term spending. A separate REIT fund is optional because broad stock funds may already own REITs. For illustration, imagine 3 people. Maya needs a car in 18 months. Most of that goal belongs in cash or short-term treasuries because the deadline matters more than maximum growth. Daniel is investing for retirement 30 years away. He may be able to hold a larger stock allocation because he has time to recover from declines, although his ability to tolerate losses still matters. Elena is 5 years from a home purchase. She may choose a more balanced mix and gradually reduce risk as the date approaches. These are not model portfolios. They show how the same investment can be useful for one job and dangerous for another. The investment is what you own. The account is the container that holds it. In 2026, the employee contribution limit for many 401k plans is $24,500. The combined annual limit for traditional and Roth IRAs is $7,500 for people under 50, subject to eligibility rules. Tax-advantaged accounts can be powerful for retirement money. A regular brokerage account can offer more flexibility for goals before retirement. The order depends on employer matching, taxes, access needs, and eligibility, so do not confuse a good investment with the wrong container for your goal. Before buying anything, ask 5 questions. What job does this investment perform? When will I need the money? What can make it lose value? What does it cost every year? And do I already own the same thing somewhere else? If you cannot answer those questions, you are not ready to buy it. That is not failure. It is a signal to keep learning. The goal is not to build the most impressive portfolio. It is to build one you understand, can afford, and can keep during the boring months and the frightening ones. 5 building blocks. Clear jobs. One plan tied to your real life. If you want more simple breakdowns without the financial jargon, subscribe to Cody Invests and tell me in the comments,
Which of these 5 investments was the least clear before today?